It's been a wild ride for uranium investors in recent months. The BetaShares Global Uranium ETF fell 19.14% between its launch on the 8th of June and the end of the month, before rallying 20.33% in July. So what's been driving this volatility, and what's changed in the uranium and nuclear industry in recent months? Let's dive in. Global equities fell hard in June, eventually hitting a bottom on the 17th of June. Despite plenty of developments in the industry, it was predominantly the mood in broader equity markets that dictated the large sell-off and the rally that followed. This is another example of the old saying that during times of crisis, correlations go to 1. It's been a very busy year in the nuclear industry, but in recent months, two major political announcements stand out. On the 6th of July, the EU Parliament voted down a proposal to exclude nuclear and gas power stations from the new EU Green Taxonomy. This is significant as it could open up billions of euros in investment in new nuclear capacity, and many EU members are now looking at extending reactor lives or investing in new capacity. In the US, the Senate passed the Inflation Reduction Act on the 7th of August. The goal of the act is to control inflation and increase energy security. The bill includes $369 billion in spending on climate and includes a range of provisions that support nuclear energy. Across Asia, Europe, and the US, nuclear reactors are seeing their lives extended, inactive reactors are being restarted, and new reactors are being approved. Japan's nuclear reactors were shut down following the disaster at the Fukushima Daiichi plant in 2011. While 5 reactors have now been restarted, progress has been slow on further restarts. If these reactors are brought online in time for the Northern Hemisphere winter, it would bring that total to 9. The longer-term goal is to have a total of 30 functional reactors in Japan. In April, the Chinese government approved 6 new reactors. In their 14th five-year plan, they proposed the steady construction of coastal nuclear power projects with an emphasis on safety. In Europe, the Belgian government reached an agreement with energy provider Engie in July that would see the lives of the country's 2 reactors extended by 10 years. The reactors are due to shut down in 2025, but after a technical review, the plan is now to restart the reactors in 2026 and run them through 2036. Even Germany is flirting with the idea of extending its last remaining reactors. Germany has long been a proponent of shutting down nuclear power, but it seems the mood may be starting to change. It seems that the nuclear energy renaissance is alive and well. Restarting closed or idled mines shows that miners are feeling confident about the outlook for uranium pricing. Uranium giant Cameco announced in February that it would bring the world's largest high-grade uranium mine, McArthur River, back into service. McArthur River has been in care and maintenance since 2018. In June, the ASX-listed Boss Energy announced it would restart its Honeymoon uranium project in South Australia. First production is expected in Q4 2023, and it plans to reach a steady state production of 2.45 million pounds per annum within 3 years. In July, another ASX-listed uranium developer, Paladin Energy, announced its decision to bring the Langer Heinrich mine in Namibia back into production. The company plans first production in Q1 of 2024 and plans to produce 5.9 million pounds per annum at peak production. Cameco, Boss Energy, and Paladin Energy are all holdings in the BetaShares Global Uranium ETF portfolio. Perhaps the most widely publicised model of supply and demand in the uranium industry is published by the World Nuclear Association. The 52-page report is available for free online, and we'll leave a link in the description below. It was published in 2021, so it may not account for some of the more recent developments in the industry. This image summarises some of the conclusions of the report. It's worth noting that for mines to be restarted and built, prices need to be high enough for them to be economically viable. As a result, there are many assumptions and estimates built into the model. The image shows that while there is a shortfall between supply and demand over the period of 2019 to 2024, this gap is expected to be filled by commercial inventory. This is essentially the stocks sitting with nuclear utilities and fuel processors. As idled mines begin restarting, equilibrium is projected to return to the market between 2025 and 2028. From 2029 onwards, as demand is expected to rise, a gap appears. This would need to be filled by unspecified supply. This basically means that they don't know where supply will come from and more exploration will be required. The BetaShares Global Uranium ETF is the first uranium-focused ETF traded on the ASX. It provides exposure to a portfolio of global companies involved in the mining, exploration, development, and production of uranium, modern nuclear energy, or companies that hold physical uranium or uranium royalties. It trades under the ticker code URNM and aims to provide a cost-effective and easily accessible way to gain exposure to companies involved in the uranium industry.